Now let's go over what is a mortgage credit simulator. It's basically a tool used by mortgage professionals to estimate how potential changes on a borrower's credit report can improve their overall scores. This simulation helps both lenders and borrowers understand the different steps that can be taken to improve the borrower's credit scores, which will potentially allow them to secure the mortgage and have better terms on that mortgage. If you're asking yourself how credit simulators work, the simulator allows loan processors or originators to input hypothetical scenarios into the system, such as paying down debt, which means you're going to enter the amount a borrower plans to pay toward the credit card balances or loans to see how it could affect their credit score. And then you can also provide them with different options by telling them how much their credit score could go up by paying down certain accounts by a certain amount, so they can see if they can afford to make those improvements. Next, closing or opening accounts. You're going to simulate the impact of closing an existing credit card and opening a new one, which is something that's very useful and easy to do and costs the borrower nothing. Correcting errors. Assessing the effect of removing inaccuracies from the credit report, such as outdated information or mistakenly reported late payments, which happens to a lot of borrowers. Adding positive payment history. Adding records of recent positive payment history to see if a booster score is something that's easy and fast that most borrowers can do. And believe it or not, you can use alternative credit as well, such as electrical bills, cell phone bills, and other things that you can have added to the credit report. And that way you'll boost the borrower's credit scores, especially when either they have limited credit or no credit at all. Once the inputs are provided, the simulator predicts the potential changes in the credit score. This allows borrowers to make informed decisions about which actions could most effectively raise their credit score before applying for a mortgage. It's not the same as when you use a credit card simulator that some credit cards offer for free, because it has so many more options and criteria that you can add on there and quickly see which changes affect in an accurate manner those credit scores. If you do it using just the credit card simulator, you might get an estimate of scores that aren't accurate and aren't real, which in the end, paying those accounts that didn't represent a necessary increase might mean wasted money and wasted time. And then you eventually have to go and get a mortgage simulator or a mortgage broker, loan originator, or loan processor to actually run a simulation and see how much they would be able to increase their scores. So it just saves them time. I would just save time by going with a mortgage credit simulator instead.